Hello and welcome to the next video in the Arielfx Beginners Course series. And this video is going to focus primarily on the concept of liquidity. And this concept and understanding this concept is going to be very critical for your foundation as a beginner in this market. It is the literal foundation upon our advanced trading concepts. All right, and it's something that you have to nail down, especially as a beginner. And if maybe you're somewhat experienced, you've never been introduced to this concept as something that is a basic concept, now you are, because it is a very critical basic concept that you can then use and apply with in terms of an advanced perspective and analysis of the market. Okay, and so we're going to dive deep into liquidity really in our advanced course, but we really want to build foundations in your understanding of liquidity here in the beginner's course. So what is liquidity? Liquidity, as it relates to the market, and when we refer to liquidity, when we analyze the market, we are alluding to money. Liquidity in the market is where is the money in the market. Okay, and quite simply, liquidity in the market is above highs and below lows. Okay, and we're going to drop down a little bit into the charts. Okay, and essentially just give you a visual representation. So we can quite clearly see here on Euro USD, obviously you can see highs and you can see lows. You can see highs, you can see lows. And this is the daily time frame. So each candlestick represents 1 day's worth of price action. Okay, and so what I mean by liquidity is there is money, there is a pocket of money, above highs and below lows. Pocket of money. So we have a low, we have a high. Above each high and above the low, there is a pocket of money. Well, a pocket of money is liquidity. A pocket of money consists of stop loss orders and buy/sell stop orders. Okay, so above this high, when price starts to move away from the high, traders who enter short positions, who sell the market, will put their stop loss above the high, which means if the price moves beyond the high and it hits their stop loss, they lose their money. They are risking their money above the high, right? And so their money is above the high. If price takes the high, their stop loss gets triggered, right? And their money is lost. They lose their money. Some people are breakout traders where they will put a buy stop order. And if you remember in a prior video, we discussed different types of orders. Above a high, people will place a buy stop order, where if price trades past the high, it will trigger their buy stop order and automatically buy the asset for them. Okay, and so with that understanding, above the high, there are stop losses and there are buy stops. Above or below the low, we have stop losses for people who buy it, place their stop loss below the low. And we have sell stop orders, where if price trades past the low, it automatically triggers the trader into a short position. Okay? And so we have to have an understanding of exactly what this pocket of money we refer to actually is, and that is stop loss and pending orders. Sell stop, buy stop. Okay? And so oftentimes people who trade a retail trading method, most people, 99% of traders trade the exact same way. They're taught the exact same way. The information is free on baby pips of the exact same strategy that most people trade. And the banks understand that. The people who actually control the market, who have the capital to influx thousands and thousands and thousands of lots in the market and actually move the market, do you think they don't understand that and don't understand the way people trade and where people put their stop losses and where people put their buy stops and sell stops? Well, they 100% do. Okay? And so we need to understand pockets of money, because it is often when price trades into a pocket of money where we look to be taking our trades. We want to see specific price action, candlestick movements within pockets of money to confirm trades, to confirm what I'm about to tell you. And that is, the banks often manipulate price around pockets of money simply to take people's money. Okay? So if you think about the fact that we have an old high here, we have an old low here, okay? Price trades down, okay? And if we denote the low, and we denote the high, and we have an understanding that there is a pocket of money here, there's a pocket of money there, okay? We know that when we see price trades past and into the pocket of money. Well, what does that mean? Well, right now, a lot of people who have placed their stop loss orders above the high because they sold it, their stop loss has been triggered. They've lost their money. The banks have purged the pocket of money, have swept liquidity. The banks have pushed price through the high, triggered people's buy stops, automatically entering them into buys, and then brought price straight back down. Okay? And so around these highs and around the lows is exactly where we're looking for manipulation into liquidity. Okay, and I'm starting to get a little bit advanced here, and I want to really keep it kind of simple. Okay, but from a basics fundamental standpoint, I really want you to understand the idea that there is a pocket of money above highs and below lows. Okay, and so oftentimes pockets of money are specifically engineered by banks, by hedge funds, the market makers, the liquidity providers who rule this market and who dominate this market. And what I mean by engineered is oftentimes, and some of you might have knowledge of these concepts that I'm about to go into. Some of you may never have heard of them, which is actually great, right? Oftentimes banks will trade into a high, or they will create a high, trade down, and then trade back up into that high and trade back down. Okay? Creating what is known as a double top. Okay? A double top. And a double top, and vice versa, a double bottom. And this is a concept that is so often taught. It's a strategy that is taught and a concept that is taught by retail traders, by the herd, by the masses. It is a pattern that most people trade because they say price has come up to this level once, it's rejected it. It's come up to the exact level twice, rejected it. I'm going to sell now. That price has rejected it, okay? And I'm going to put my stop loss above the highs, or vice versa. It's rejected support once, it's come down into that same level twice and rejected it. Therefore, when it rejects it this time, I'm going to place my stop loss here and I'm going to buy it. Okay? And this is a classic method of engineering liquidity, engineering a pocket of money. Oops. Creating equal highs, a double top, creating equal lows, a double bottom. The banks have engineered a pocket of money in terms of stop losses, buy stops, and sell stops, where most people understand that price is probably going to trade lower, but end up getting stopped out before the actual move happens. Getting stopped out before the actual move happens. Okay? And so this is where, if you have been taught, or if you trade double tops or you trade double bottoms, you need to scrap it immediately. Okay? And you have to understand that we are patient traders and that we don't trade off of equal highs and we don't trade off of equal lows. Okay? We wait. We understand and we mark off our liquidity. We mark off our equal highs. We mark off our equal lows. Okay? And we delegate, or we identify these areas above equal highs and areas below equal lows as pockets of money. Okay? And so as a basics in a beginner's course, this is the very first thing, or a very fundamental concept that I want you guys to apply to your analysis now as a beginner, is when you open up your chart, identify where the money is. Where is your pocket of money? Specifically, as a beginner, it's a great way to start out, is identify your equal highs and identify your equal lows. Okay? And we are not trading off of the equal highs off of the double top. We are not trading off of equal lows off of the double bottom. Okay, now we want to wait and we want to look to see what price does upon sweeping the liquidity, upon purging equal highs, upon purging equal lows. And that's where we're going to be getting into more advanced concepts later on. But for now, the goal is for you to train your eyes to really identify areas of liquidity within the market. Okay, so there's really, as a beginner, there's two concepts that I want you to understand, or two concepts that I really want you to apply as a beginner as your foundation for your analysis. And that is number one, identify market structure. Are we creating higher highs and higher lows? Or are we creating lower highs and lower lows? That is number one. The first thing you do when you open up your chart, identify market structure. Identify the trend. Are we creating higher highs and higher lows, or are we creating lower highs and lower lows? Something that we've gone over. That is the first thing you do. The very second thing that you do then is identify where is the money. Where are my pockets of money? Where are my equal highs and my equal lows? Okay, so that is number two. So, number one, identify your market structure, your trend, your directional bias. And then number two, where is your money? Where are the pockets of money? Where are my equal highs? Where are my equal lows? Okay? Once you are able to master these two things, the advanced concepts and the way we enter, based off of how price responds within a pocket of money, we can then get into the more advanced concepts. We can identify very specific entry points based off of clues the banks have left upon purging, upon sweeping liquidity, upon entering the pocket of money. But you will not be able to apply advanced concepts if you don't understand these very two critical basic concepts. So we don't even need right now, guys, to worry about what to do, how to enter, right? We really need to worry about focusing on these two elements: identifying our structure, our trend, and identifying the money within the market. The very first, I still do these exact same two steps when I open up a chart. Okay, so we'll get to the good stuff later in terms of advanced concepts and techniques. But for right now, if you don't understand the basics, it will be impossible for you to understand or apply the advanced techniques and concepts. Okay, so now I would urge you to start testing this. Not testing it, but applying it. Open up a pair, identify your market structure, and then identify your money. Back test, go back into the past and find these levels. with an understanding of your directional trend and market structure. Okay?